Hello, everyone. Welcome to our Chapter 17 video lecture. We're going to focus on understanding accounting and financial information. In Chapter 17, we'll discuss the role of accounting information, what's known as the accounting cycle, understanding key financial statements, analyzing financial performance using ratios, and accounting disciplines. So, you ready? Let's go. Here we have Shelly Sun of Bright Star Care. She is what's called a CPA, a certified public accountant, and the vice president at a major insurance firm. After having trouble finding quality in-home care for her grandmother, she decided to start her own business, Bright Start Care. She credits the success of her company to her accounting background. So we'll talk why an accounting background is instrumental to be successful in running a business organization. So, what is accounting? Accounting is the recording, classifying, summarizing, interpreting of financial events and transactions to provide management and others interested the information they need to make good decisions. So to summarize that, we're saying is that what accounting does, it takes a company's everyday business transaction and turns that into useful information to make decisions about that particular company. Now, the method used to record and summarize accounting data is known as the accounting system. So it's the accounting system again that a company is going to use to record and keep track of all of their financial transactions. Now we're saying who are the stakeholders of a company? The stakeholders are that company's employees, their owners, any creditors, unions, investors, and the government. They all make use of a firm's accounting information. So, in essence, anyone that has an interest in a company can become a stakeholder of that business organization. Now, in accounting, we have a set of rules that we call GAAP. GAAP stands for Generally Accepted Accounting Principles. These are the accounting rules, the accounting guidelines that instruct us on how to perform our job in the accounting profession. And for those who know, yes, I am by trade an accounting professor, so this chapter is one of my favorite chapters for this class. First, we'll look at accounting documents, what we call source documents. These are the actual transactions that are going to describe the types of business transactions that have taken place. So if we sold a product, there could be a service, a sales document. If you bought a product, a purchase document, payroll records, bank records, entertainment records. So these are what we call source documents, evidence that a business transaction has taken place. Now, during the accounting process, we're going to take information from these various source documents and record them into what's known as our accounting system. We're going to make what we call journal entries. Journal entries are a transaction to record the actual events that have taken place for a company over a specified period of time. From the journal, we're going to post those transactions what we call ledgers. So for some of you who may have already took an applied accounting course or maybe financial accounting, every account, whether it's cash, account receivable, revenue, has what we call a separate ledger account. The ledger is used to keep a total of that account's balance. When it says classifying, accounting information is put into certain categories. There's something called asset accounts, liability accounts, revenue accounts, expense accounts. So in accounting, we have to take the information from these source documents and record it into the appropriate category. All accounts are going to be summarized, meaning at the end of a select time period, we're saying what is the ending balance for those different accounts. Now, once you recorded all the transactions in the journal, you post them to the appropriate ledger accounts. You summarize all the accounts. The output will be called financial statements. These are reports prepared on a periodic basis that would tell us certain information about that business or organization. There are different types of financial statements, what's called a balance sheet, an income statement, statement of cash flow. So we'll take a look at some of these different types of financial statements. We now focus on who are the users of accounting information and what type of reports are required. Well, this first group we all know, the Internal Revenue Service. Both companies and individuals who have earnings are required to prepare an annual tax return. For companies, sometimes they prepare these returns on a quarterly basis. Okay? These financial statements that we're going to talk about are found in what's called an annual report that I'm going to show you all a copy of in a few. And inside this annual report, it will consist of different types of financial statements, such as an income statement, a balance sheet, a statement of cash flow. Again, these statements are used to make decisions about these business organizations. These statements provide us with financial data. So before you decide to invest in a company, work for a company, loan money to a company as a creditor, you should first review their financial statements. Okay. Now, how do we take everyday business transaction and turn it into useful accounting information? There's something called the accounting cycle we'll take a look at, which is a 6-step procedure that results in the preparation and analysis and producing of the major financial statements. Now, there are many jobs in the accounting profession. One such job is that of a bookkeeper. The bookkeeper job is to record all of the company's business transactions. What the bookkeeper does is divide the firm's transaction into meaningful categories and post them into a book or a computer known as their journal. So when it says meaningful categories, again in accounting, we take those everyday business transactions and we classify. We're going to separate our asset transactions from our liability transactions, from your revenue transaction, etc. And again, when you take your accounting course, you're going to learn more about those categories used in the accounting profession. Double entry bookkeeping. What is that? Well, it's the practice of writing every business transaction in two places. So to provide clarity on that, in accounting we have what's called a cause and an effect, meaning that if something happens, we're saying what caused that to happen. For example, if a company now has an increase in their cash account, what caused the increase? Did the company borrow money? Did they provide a service? Did the owner make an investment? So what we're saying here is that if my cash account increased, some other account is involved in the transaction as well. That's known as double entry bookkeeping, where at least two accounts are involved in the recording of every business transaction. Here we look at the 6 steps of the accounting cycle. So let's talk about these 6 steps. Step 1 is to analyze those source documents. Again, those could be the invoices, purchase orders, payroll records, cancel check, etc. Those source documents, again, are evidence that a business transaction has taken place. So now we're going to record the information from those source documents to what's known as the journal. From the journal, that data goes into what's known as a ledger account, which is known as the posting process. And again, every account title has its own separate ledger account. After we done post to the ledger account, we then prepare an internal statement known as a trial balance. This is a statement that proves the quality of our debit and credit ending balances. I won't go into too much detail about that, but again, when you take your accounting course, you'll learn more about this internal statement known as a trial balance. We'll then prepare our different types of financial statements, a balance sheet, income statement of cash flow, or some of the major or standard financial statements, and we'll take a look at a sample of each of these statements. And then we want to analyze those financial statements. So what are those statements saying about that business organization? Were they profitable? Did they lose money? Did they make money? Do they have a lot of assets? Do they have a lot of debt? So again, these statements provide us with financial information about these different business organizations. So a ledger is an accounting book or a computer program such as QuickBooks in which information from accounting journals are accumulated into specific categories and then posted. So, for example, you will have a cash ledger account, and that cash ledger shows all of our cash transactions. It shows your cash inflows, it shows your cash outflows. It also keeps a running balance for your cash account so that at any time during the accounting cycle, we know how much do we have in our cash account. Then the trial balance, which again is an internal statement, meaning this statement is not seen by those outside of the business. It's a summary of the data from the account ledgers. So again, at the certain time period, you determine what is the ending balance for all of your ledger accounts. Those accounts that we call a debit balance or a credit balance. So we prepare the trial balance. Its purpose is to prove the accuracy of our account ending balances. If done correctly, the total of your debit balances will equal the total of your credit balances. Now in 2023, most companies use computerized accounting programs in order to record their business transaction. QuickBooks is the most widely used accounting software for small business owners. QuickBooks has what we call QBO, QuickBooks Online, and as a plug, Accounting ACC 120 is a course that I teach that shows you how to use accounting software to record your business transactions. With the class again? Okay. Yes, ACC 120 is a computer accounting software course that shows you how to use accounting software to record a company's different types of business transactions. Okay? So stay tuned for more information on our Chapter 17 video lecture. Bye.